Today, I'll talk about how to complete a successful second charge mortgage comparison. Now, I know it can be a bit daunting, so I want to try and make it a little bit easier for you. Before we get into more detail, I want to explain what second charge mortgages are. These are secured loans that use your property as collateral. They're also known as homeowner loans or home equity loans. The amount that you can borrow depends on your property's equity, the lender's loan to value, that's LTV for short, ratio, and your personal finances and credit score. However, they do come with some risk. If you can't keep up repayments, your home could be repossessed, and if the property value decreases, you could find yourself in negative equity. I know this might sound a bit scary, but don't worry. You're not alone. There's plenty of professional advice and support available from community money groups and debt charities to credit and mortgage brokers. The term second mortgage might be a bit confusing, as it can also refer to a situation where you're buying another property and need an additional loan. However, I'll be focusing on second charge mortgages or loans against your home equity. Now let's talk about how much you can borrow. The amount will depend on the equity in your property, the lender's loan to value, LTV ratio, and your finances and credit score. Most lenders allow you to borrow up to 80% of your equity, but this could be lower depending on your personal circumstances. While second charge mortgages offer an opportunity to borrow significant amounts, they do come with risks. It's important to be aware that if you can't keep up with your repayments, or if your property value decreases, you could face repossession or negative equity. When it comes to comparing second mortgages, there are several factors to consider. You need to ensure the lender is legitimate and authorised by the FCA, that's a Financial Conduct Authority. Look at their interest rates, appraisal fees, other loan fees and early repayment costs. You can use second charge mortgage calculators and comparison websites to make this process easier. However, remember these tools might not always provide completely accurate results or cover the entire market, so do some independent research as well. Second charge mortgage rates are often higher than first charge mortgage rates due to the additional risk associated with more debt. However, by comparing the market effectively, you could still find a competitive deal. I can help you out with that at the end of the video. While a mortgage company can refuse a second mortgage if they believe you might struggle with repayments, you can also take out 2 second charge mortgages on the same property, provided that you have sufficient home equity and the lender agrees that you can afford the repayments. Let's talk about home equity loans versus second charge mortgages. Both are ways to borrow a lump sum using your home's equity, commonly used for home renovations or debt consolidation. The best option between the two will depend on your personal circumstances, finances and preferences. Remember, this is a significant financial decision, so ensure that you seek professional advice if needed. If your credit rating is low, then consider improving it before applying by checking for mistakes on your record through a credit reference agency. If you're considering a home improvement loan, click the link below and fill out the short form. It contains a few questions like whether you're a homeowner and how much you'd like to borrow, and will give you access to quotes from around the UK tailored to your circumstances. It's totally free to do, and of course it won't affect your credit score. Click the link below, fill out the short form and give it a try.